Okay, Tyler. So General Motors reported on October 24th before the market opened, and investors looking at electric vehicles, the EV trend, probably should be paying a lot of attention because I think they issued a bit of a warning here in some statements that they made. You ready to have a conversation and go through GM's earnings, what they said, and lay the groundwork for investors?
Let's do this. It's earnings season is upon us. It's time to go.
It is. And as much as investors looking at EVs want to focus on Tesla, which is they set the market and are looking at a lot of the EV startups, the big companies like GE that are making a lot of money and selling regular vehicles, but have also committed billions to EVs, you should know what they're doing too. I'm Jason Hall. This is The Smattering. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas than what we're going to talk about right now, please go to our special link, fool.com/The Smattering. The Motley Fool is going to give you its 10 best stocks to buy right now. Please check that out after watching this video. Okay, Tyler, I'm going to hit the high notes here. Revenue was up about 5%. Earnings were down. Net income was down. Cash flows were solid. They were really strong. Probably the most important thing from that table to note in regards to the ongoing strikes with the UAW that all of the big three are dealing with in the US. The vast majority of the quarter was over by the time the strikes began. They started in mid-September, and the strike probably had de minimis actual impact on operating revenues. It might have actually helped operating costs a little bit because the vehicles that they sold in the quarter weren't being manufactured on September 20th, right? So we
Yeah,
haven't yet
it's
seen the impact of the strike on business.
yeah, this is short-term stuff. If you're long-term investing, this is the temporary blips. But when something like this happens, you're going to have inventory drawdowns, which in the short term makes your cash look pretty good because you've got all this inventory of existing vehicles that are now clearing your lots, heading off to dealers because dealers need to sell something, and when you're not making new ones, you got to have something. So this is one of those things that, like, I feel like a year from now it's going to all come out in the wash because what I don't know when, but they are going to sign an agreement, and when they do, they'll start producing again, and you'll typically see a rebuild of inventory, and cash will be drawn down a little bit as a result to, in management jargon, normalize inventories.
I think it's important to note too the kind of targeted approach that the UAW is taking to strikes is all of their workers haven't gone out. They have a select number of workers at specific factories that are striking. And it's interesting because they're hitting the big three where it hurts the most because they're targeting pulling those workers out of really important profit centers that hits the bottom line for GM and Ford and Chrysler and Jeep, part of Stellantis, but it keeps all of the other UAW workers working. So it's an interesting approach that they've taken. And it's going to be the end of the current quarter, sometime early in 2024, when we're going to actually find out the financial impact of that. But again, like you said, it could normalize over
Yeah.
time. It should.
According to Mary Barra, in her shareholder letter that she sent out in accompaniment to that press release, said that at the current striking rate, based on the facilities that are currently on strike, GM estimates that it's costing them about $200 million a week. And again, this is based on their present shutdowns. If the UAW were to target GM with further shutdowns, it would obviously increase that over time. But that's where they see it right now. And it's part of the reason why General Motors completely removed their annual guidance for the year because they really don't know where this strike is going. And, what that's going to mean for fourth quarter profits or earnings, nobody really knows.
A lot of people are watching this video, Tyler, because we talked about EVs. And my first words were kind of issued a bit of a warning for the EV market right now. Let's talk a little bit about that. As a beginning point, where is GM with its EV ambitions? They've made some pretty good commitments and they have some interesting things in the pipeline.
They did, but those pipelines are now considerably smaller than they were. I believe that the run rate that GM was looking for next year, if I don't quote me precisely, but I think it was somewhere around 400,000 units or vehicles a year in EV production, which, by its own regard is a pretty decent number. But as of this most recent quarter, they have decided to throw those out the window. And just to, I apologize, I'm going to read this directly just because I've got what the statement was from the CEO. It says, "We are moderating the acceleration of EV production in North America to protect pricing, adjust to slower near-term growth in demand, and implement engineering efficiencies to make vehicles less expensive." So the thing that really stood out to me in that statement was the slowing of near-term demand growth. And that's something that anybody who's looking at EVs today needs to pay attention to, because it's something that has been echoing in other companies lately. We've seen Tesla's numbers. Yes, they're still growing at a good clip, but the rate of growth is slowing down. GM is basically admitting like the demand growth is slowing down. And I assume when we start to see some of these other EV companies start to report, and we see Ford start to report numbers, I would not be surprised to see if you see something similar, because I mentioned it. We were thinking about this before, but sometimes growth and disruption and things doesn't happen on a linear scale. And so we've seen this increase in adoption for EVs. And I think there was this kind of assumption that it was going to continue at these extremely high penetration rates. But sometimes the customers that you're targeting with that higher penetration rate, or the amount of people that are adapting to do EVs, you start to run into more of the skeptics and the people you need to convert to the idea that an EV is a good solution for them. And I think this initial wave of penetration that has been quite fantastic was the years of pent-up demand for electric vehicles that has more or less been satisfied now. And now we're getting away from the voracious early adapter group to the slight skeptics and the people who are going to weigh the costs and benefits of purchasing an EV versus a traditional vehicle a lot more vigorously. And because of that, as GM says, we're seeing a slowdown in demand. How long that lasts, I don't know. But it was something very much of note, and very much in contrast to what we've seen at Tesla, because GM is basically saying we're going to slow down our pace because we want to maintain pricing and profit to make this a profitable endeavor for us for the long term. Tesla is basically saying we're going to run in headstrong into this. We can sacrifice margin, and the big focus for us should be scale production, and then we can get cost efficiencies from there. It's a very different approach, and it's two dynamics that'll be interesting to see what works.
I do think that's part of it, right? We're seeing a little bit of a shift in the customer mix away from those, like you said, the early adopters, and more people that just want a car. There's a price people are willing to pay for a thing, right? And then once things get to a certain price, they're no longer attractive. And I think that what we've seen with EVs is, number one, if we look at inflation, it has been such a rampant challenge for the automakers. Looking at, for example, Ford's Lightning pickup, when they first announced it was around $40,000 for the entry-level model, and it was close to 50 by the time they were actually producing the vehicles, right? And we're talking about around a year, less than a year from pre-order to the first commercial deliveries. That's a huge increase from 40,000 to 50,000 for that one vehicle. And we've seen the same thing happen through the entire supply chain for electric vehicles. And over the past year and a half is interest rates, right? It's not, even though a lot of the automakers are still offering very attractive interest rates, they're having to subsidize the cost of financing, right? So that part of the model has changed a lot too. Price is maybe a bigger factor, or as big of a factor as where we are with the kind of customer that these companies are targeting. But the key thing is, I think that this is a clear warning that for whatever the specific reason or group of reasons, Tyler, investors who have invested in automakers writ large, whether it's the big auto or whether it's Tesla's RIVN or any of these companies, need to be aware that there are changing dynamics and customer dynamics as well that don't necessarily bode great in the near term. And you need to be mindful about that before you invest in any of these companies on the EV future, because you could be stepping into a value trap. You could be buying a growth story that's not maybe going to be so growthy in the near term. And particularly for these companies that are burning through cash, I think that's the big warning that investors need to consider before making any step into any company based on some big, bright EV future.